Again, a lineup of keynote speakers, the first of which is my privilege to be able to introduce. Mr. Jim Mulva has just retired as the chairman and CEO of ConocoPhillips. He started his career after earning his bachelor's and master's degree in finance from the University of Texas. He served in the U.S. Navy, and immediately after that started working at Phillips Petroleum, 1973. He was named the CFO in 1990, President and Chief Operating Officer in 1994, and served as Chairman and CEO of Phillips Petroleum till 2002. At that time, he directed the merger of Conoco and Phillips and has led them until his just recent retirement. As under Jim's bold and stewardship that ConocoPhillips grew organically, they grew by acquisition, but his leadership led them to be classified as a super major and one of the top Fortune 500 companies, one of the top companies in the world. 30,000 plus employees, 40 plus countries around the world. I find it even more interesting that his bold leadership and his focus on creation of value for shareholders led him then to lead that company, a super major that he grew to split into upstream and downstream companies to bring even more value as times have changed to his shareholders. I'm excited that Jim agreed to come and speak with us. He is now a director. As I said, he's retired. He's a director for General Electric, General Motors, Green Bay Packaging. He's a member of the Board of Visitors for MD Anderson Cancer Center in Houston. Please join me in welcoming Jim Mulva.
Thank you. Wayne, thank you very much for the kind introduction. I'm very pleased to be asked to present a keynote address to the annual conference of the Construction Industry Institute. Wayne, several months ago when he asked, he said I'd be interested, and he said, thought the participants would be interested in my reflections on how we grew and developed ConocoPhillips, because it's applicable not just to our company, but to many organizations. And so I would spend a few moments talking about that, as well as strategies, leadership, management, the business environment, political environment, all these different issues. So I'm going to try to cover all this in about 30 minutes. But before I do so, one of the things I've become quite familiar with the CII many years ago, knowing Richard Tucker and John Mihm was a close associate of mine in Phillips Petroleum Company. They're pretty instrumental in the initial development of the CII. So I have a first slide here. These are my reflections on the importance of CII. And from what I've seen over several decades, CII provides a really good objective assessment of the industry's capabilities and performance. And this is very helpful because you give to us best practices, and that helps us on value creation within our organizations and our company. You do a lot of research with respect to process improvement, provide consulting services to our companies and to other members of the Institute, and that's very, very helpful. But it's not just the science of it, the research. You also recently, over the last number of years, spent a lot of time on organization, people, leadership development, and that's very helpful. And I would say CII is certainly a strong, strong asset for the Department of Engineering at the University of Texas and the University of Texas at Austin in general. And so what you do and what CII does, as speaking as a member company, is really very important to the success of our organizations. Here's what I'd like to cover. As Wayne asked, he says, why don't you spend a few moments and talk some about how we grew and developed ConocoPhillips. I picked the time period because that's the time period that I know most about the company, when I first became CEO of Phillips Petroleum Company in 1999. Talk about some of the challenges and leadership issues regarding organizations of scope and size of this company. And then, as I said, assess what do we see taking place today in the world business and political environment. Do we have a national energy plan? Well, you probably know what my response will be on that. And then as Wayne said, well, if we created this company, why did we just recently decide that we would split it into two companies, upstream and downstream, to grow and develop? And then some personal comments with respect to leadership and development of organizations. That ticker box on the bottom is really quite important. Irrespective of the public perception of our industry, I believe I've always worked for a noble industry. There's no industry as scope, size, technology, political involvement, whatever, but we, as oil and gas industry, are energy providers, which really grow and develop the economy and standard of living. And so it's most unique, and I have to say I'm so pleased that I've spent the better part of almost 4 decades in this industry. Let's talk about the growth and development of ConocoPhillips. As I said, it started in 1999. I started in 73 with Phillips Petroleum Company. And if we looked at Phillips in 1999, we essentially had a tiering. This is before the NOCs and IOCs the way we know it today. But we had 3 tiers of, I would say, oil and gas companies. You had the first tier, which is the very largest, Exxon, Mobil, and Shell. The second tier were people like Chevron, Texaco, BP. Third tier were companies like Phillips, Conoco, Marathon, Unocal, the third tier. So we assessed in 1999, we looked at Phillips Petroleum Company and said, well, we have really 3 alternatives. We can sell out, that was really sell to another company. That didn't make a lot of sense to us because it's fiercely independent. We always thought we could create more value for the shareholder by being independent. Just carry on doing what we were doing, and we didn't think that was sustainable, or be bold, step out, and start to grow and develop the company, which is the alternative we followed. So those were the options. Those were the alternatives. So we developed a strategic plan. The strategic plan was what did we want to look like 5 and 7 and 10 years out into the future, which was to grow and develop to have scope and size, to compete around the world. And if you're going to compete around the world, people and countries want to make sure and know that you're going to be here tomorrow, so you had to have the scope and size to be able to do that. So we felt, it was important to be bold, to step out, and what's very important is to execute the strategy as well as you possibly can. I put on the slide, strive for perfection. We always strive for perfection, but we know we don't achieve it. But most important thing is you got to get the big things right, and that's really important. And as you go through times, in what you do in your respective organizations and what you do for your companies or organization, things don't always go as we would plan. So you can't dwell on the past. It's important to learn, adapt, keep moving, but that's a very dynamic situation in organizations that we work for. And the culture of an organization, I'm going to talk a bit more about that in a moment, that's awfully important. So the bottom ticker box on this slide is, in any organization, you've got to play the game. To be successful, you've got to play the game, you need to play it aggressively, and you have to win. So let's just talk about this growth and development of ConocoPhillips. And I use the Fortune 500. We go back on the left-hand side of the slide. It's interesting, by the way, not just to see where Conoco and Phillips and what ConocoPhillips, if they were together in 1999, what their size would be. But it just shows how dynamic industry and things change from one period of time to the next. Obviously, you can see with the higher oil prices, the integrated large oil companies now essentially dominate, from a revenue perspective, the largest companies. This is in the U.S. It just came out, I think, the most recent Fortune. ConocoPhillips, before it split, this is the end of 2011, would be number 9 in the world. So there's been a pretty dramatic change in the size of the company by the strategy that was followed in creation of ConocoPhillips. To show it in a little bit different form, we look at net income. That's the bottom or the top part of this slide. And on net income, you just can see the scope and size of the companies, what they would have been in 1999 what the results were for 2011, and what's the percentage change. Well, obviously, with higher oil prices, all the companies have done well, but it's a relative change, a relative growth that's important. Market capitalization, again, you can see what happened to market capitalization of the companies. And I would say that at $93.7 billion market capitalization of ConocoPhillips, it actually could have been much larger, but ExxonMobil and ConocoPhillips have been pretty aggressive with respect to share repurchase. Felt that creates value for the shareholders. So as you buy in shares, your market capitalization goes down, but hopefully with time the share price goes up. So a pretty dramatic change in scope and size with respect to ConocoPhillips. But the real question is, you can get larger, but are you really creating value for the shareholder? That's what it's all about. It's creating value for the shareholder. And this next slide just shows for the time period. And when we say shareholder return, it's the same peer group of companies that you've been seeing, the largest companies, ExxonMobil, BP, Shell, Chevron, Total. The red line represents share price appreciation and dividends. That's your return that the shareholder gets. And then it just shows over a period of time what's been the compounding of this, 13%. So we feel we've been pretty good with respect to returns to a shareholder. The average of those large publicly traded companies shown in black at 9%. ConocoPhillips is number one. Number two is Chevron. I think Chevron was close to about 10 or 11%. Very interesting in the general equity market, if you look at this, that's the green line. You have heard people talk about the lost decade of investing in equities over the last 10 years or so. Well, that's really reflected in the green line. The upper right-hand repositioning, when we had the deep financial crisis that took place in 2008, our share price dropped pretty dramatically, and we took actions to reposition the company more aggressively on how we invested money and our cost structure and everything, and so we regained what we lost in 2008 by the end of 2011. So the question really becomes then, well, how is all this accomplished? It goes back to the strategy and strategic of the company, the plan. Develop and execute a bold plan and vision for the company. When I became CEO of Phillips Petroleum Company, several directors at the time sat me down. They said, you know, over a period of time, 3 years, 5 years, we can invest billions of dollars in projects, do projects, and maybe acquire a company or a project. And after that period of time, say, look what we've accomplished. And that's not what we want. Because we didn't know that's what we were going to do when we started. What we want is we want to outline what we want the organization, the company to look like 5 and 10 years from now. And everything that we do, invest in or acquire or do, must fit within that envelope of what we want the company to look like 5 and 10 years from now. And that's exactly what we did. And the second bullet point here, what we did is we accomplished it about 50% organic growth, which is capital projects that we undertake within the company ourselves, and 50% were mergers, acquisitions, type transactions. And the average is between, over this period of time, $75 to $100 billion of CapEx, $75 to $100 billion of M&A deals, and average is about $15 billion of investment every year. That third point is really important. When you go through so much substantial growth and development in a company, it's been my experience, you really need two distinct types of teams that must be coordinated really well. There's a team that does deals and makes decisions and accomplishes transactions. But then you have to have another operating, executing team that does the organic growth, assimilates and takes what you acquire, because you cannot have a hiccup at all in this business and your license to operate with respect to operating excellence and good HSE performance. And so it takes a combination of skill sets and teams to really do this well. And then as you're doing this over a period of 10 or 12 years or whatever, you have to maintain financial flexibility, because as we saw in 2008, if you don't have financial flexibility or you don't have the HSE performance that you need, you can lose your license to operate, you can lose the ability of creating value for the shareholder. Shareholder always wants to, even though we're in a very long-term business, we invest in things that take 10 and 20 years to do. It takes us sometimes 10 years. We get a license to explore. First production is 10 years later, cash flow. But the shareholder wants returns immediately. and culture. I'm going to have a slide or two to talk about leadership and the importance of culture. And from a personal perspective, I always felt it was important. People like this, they like pleasant surprises, and the shareholders in the marketplace under-promise and over-deliver. So what I'd like to now talk about is, this is how we've accomplished this, but what Wayne asked, well, why don't you talk a little bit, is it more challenging to grow organically or through M&A transactions? And you can see from the slide right from the beginning, there's more issues on M&A transactions, so I think it's a bigger challenge and a greater risk than organic growth. But let me just go through this for a moment. As you can see in the top part of this slide, there's always deals that you can acquire and invest in. The question is, are they value creating? And you can always get buyer's remorse because of higher prices or whatever, you can end up paying too much for something. So are really good deals available? It's always a question. And then another thing important in the oil and gas business is when you do a deal, you have to assess what do you think is a political environment with fiscal take, but you also have to take a view, are oil or gas prices high or low, and what are they going to be for the long term? Because it has a great deal to do whether this is going to be a good investment for the company or not. And we always felt as a company it's very important to not invest or acquire into a decline curve, because that just aggravates, if you buy something that has a steep decline curve, then it just aggravates your ability of your company to replace your reserves and keep your production up or increase your production. Government approval takes a lot of time, and I've got a note or two, a little bit more on a subsequent slide. And you never have enough time to do due diligence. So when you're doing an M&A deal, either for competitive purposes, you want to get it done quickly before someone else gets the idea to get in the middle of it, or the seller says, here's the date by which I want the bids in. So you never have as much time or information on due diligence. And as you see there on the slide, when you do a big deal, they're lumpy, and they're very transparent, and everyone can see the good parts and the warts regarding to an M&A type transaction. Culture is always a challenge. Now, organic growth, project management, as CII really knows, and that's essentially the driver of everything that CII does. Project execution is so important. Warren Buffett has always said, always be concerned whether the last 10 or 15% of cash that's spent is value creating for the shareholder. As you can see on the bottom part of that slide, we as an industry tend, when things are going really well, we tend to spend a lot more money when times are going well. We actually manage to do our projects better when we have a little bit less cash flow, and we're trying to make everything more value creating for the company. The project execution is critical. And when you do capital spending, organic growth in a company, it's not as transparent. So for all the reasons I put here, I think M&A has its challenges, is more challenging, more difficult, value creation-wise, as compared to organic growth. Now, what are some of the unforeseen challenges and issues as we grew and developed ConocoPhillips? Right at the very top, I would say, is the people cultural issues. And the second point there is very important, is corporate governance, is how you do things within a company. Now, the old Phillips Petroleum Company is more centralized from the top down. The old Conoco is more decentralized. And ConocoPhillips is not just Phillips and Conoco, it's Arco, Alaska, it's Tosco, it's Burlington. So it's really a United Nations amalgamation of different cultures. And this is really pretty difficult to do. But it was, and we had very strong HSE performance through all of this. And I would say, despite the tough cultural issues, the real reason the company is quite successful is because of fundamental commitment, irrespective of where the heritage and where the employees came from, the fundamental commitment that and pride that we do this well and we will get this done irrespective of the culture of the governance issues. The employees and people, irrespective of what people will say, employees don't like a lot of change. We as humans don't like a lot of change, but it's something you have to adapt and accept. Due diligence, my comments are already made on due diligence. And employees are really very smart, very intuitive. They understand in their mind why a company would make a decision. Intellectually, they understand it, but getting the buy-in from the heart frequently can be pretty difficult to do. And there's never enough time for communication. And so when you're making a lot of change in a company, what we found frequently is from the very top, you're communicating as best you can, but middle management at times, they don't get as much information or as much buy-in, and frequently, as you look at an organization, the communication side of it, where there gets some failures between the top and the very bottom, is the middle management. And I'm just saying I'm not sure that's true in all organizations, but that was certainly true in our experience of our own company. Now, some other important consideration, government approval process. When you do a merger, acquisition, sometimes the approval process takes the better part of 12 months. And that's a long time period when you're thinking about what's taking place in the equity markets, share prices, and what's taking place in oil and gas prices. And a deal may look good today, but over a 12-month period of time before it's completed, maybe it looks a lot better, maybe not quite as good. And the other thing that happens with the government is when you go and do a large transaction, it frequently can have an impact where they slow down because they're working on a deal and approving a deal, getting approvals, regulatory approvals for your existing ongoing capital expenditure, organic growth. And then the financial markets. In the financial markets, when you're making a lot of investments or M&A type transactions, they're looking and assessing what they think of the deals that are being done from a price point of view, government regulation, are the availability of capital markets, what's happening in the stock market, and the rating agencies can change their assessments. And from a shareholder point of view, you have the buy and the sell side. Let me just explain. Buy side means those are the shareholders, the large institutional investors. They buy the shares, they own the shares. And so from a shareholder point of view, you want people who own the share, are existing shareholders, to continue to remain as existing shareholders. And you want new people who are not shareholders to become shareholders. The sell side are the analysts. Those are the people, very influential, that write about whether they think the company's on the right track, doing the right deal, making investments or inorganic growth. So those are some pretty important other considerations. Leadership. I've been asked by Wayne to give a few thoughts with respect to leadership attributes. Strategic vision. Well, earlier I commented about directors and the company wanting to know, what we want the company to look like 5 and 10 years from now. Strategic vision, know what the opportunities are, know what the alternatives are. I've put on this slide, from my perspective, it's always interesting the way I connect with it and talk with people is say, who can look around the corner? Who can look around the corner to see what the world may look like, what may come over the next several years, because that's very critical with respect to assessment and what the value of the best opportunities, alternatives are. And you need to communicate what you want to be. Building a cohesive team. Jim Collins has written several books on leadership and development and good to great and companies and all that. And he talks about getting the right people on the bus. Because if you get the right people on the bus, they'll determine where the bus ought to go. So getting the right people on the bus is really important. And as I said earlier, it's important to have a good combination. You'd like to say everyone in your organization and your leadership of your company, they're great deal makers, they're good operators and all. There are a few that can do everything absolutely perfectly, but not too many. So it is important to make sure that you have good business types, good operating types. And the other thing is, in any organization, I don't care what your level is and what your type of organization, you have to have some close confidants. Whether they're 2 people, 5 people, not 10, but you have to have 2, 3, 4, 5 people. It's a really close confidence that you can sit down and talk with, or they come unsolicited, and give advice and say, I'm not so sure that's the right thing to do. So it's important to have some good close confidence. The other thing is it makes whatever you're doing and where you're working a lot more fun. Be bold, take risk, but when you say take risk, never bet the company. And the other thing is absolutely never compromise operating excellence and HSE performance. And you're going to get criticism and there's going to be adversity. And you just have to see through it and stay the course with respect to growth and development and execution of your operating plan or your strategic plan. And the other thing is, whether it's a stock market, the board of directors, your supervisors, employees, everyone likes to see something that wants to see an organization and likes to see in yourself as a supervisor, as a leader, to be consistent, and I say be predictable. Employees like to know they're coming to you, whether it's a capital, you're bringing a capital project to the management and say, should we do this, should we not do this, how to do it. It's good to know that what generally is going to be the reception and what's within the envelope of what's acceptable. So people, it's important to be consistent, be predictable, be fair on question ethics. And the bottom ticker box in that slide sums it all up. As a supervisor, as a leader, whatever, in your respective organizations, people who are good read of situations, they're good read of people, they usually excel at supervision and leadership. So I come down to the importance of people and culture. And how do I put this slide together? It's somewhat backwards in a way. So what are employees, what are people looking for? In the top, it says what they're looking for is they want to win. Everyone wants to win. They want to be associated with a company that wins. It's safe, it's ethical, it's moral. And they want to work in an organization that they can develop themselves, be a part of an organization, part of a team, a lot of pride. Everyone wants to be proud of where they are and who they work with. And they want to have some fun. So how do you make that happen? I think you have to have a performance-based culture, transparent, it's fair, and people are consistently, decisions are made in a way that's fair and recognition is done. And it's not just compensation, it is other forms of recognition. And all organizations, when you make decisions are made, what's really important on communication is why are they made and how are they being made and how are we going to implement these decisions? Those are the really important things. Governance, clear governance and accountability. Who does what and how we're going to do it is important. Diversity, it's good to have diversity of opinion, but in the end you cannot have everything decisions made by committee. But what you do want is get the opinions, get the thoughts out, everyone has their view, and make a good, well-informed decision, but then there needs to be buy-in. And the last point on this slide, know your organization. And when I say know your organization is if you don't know, if you think everything's going really well, but it's not going really well, it's not hitting on all cylinders, and there's untapped productivity that can be significant value creation for a company. So that's one of the things that I would say that I've learned and have seen, it's really important is anything that you can do to get your feel of the pulse of the organization, the pulse of the employees and how it's working and how it could work even better is very important in value creation on productivity. And then I've been asked to switch here a little bit and talk about the current environment that we see in our oil and gas industry, but what we also see in business in general. And at first third of the top of that slide, the business and the political environment, we're going through a really deep multi-year worldwide recession. You know that. The European crisis, all the governments essentially, with the exception of a few that are producing nations or who have really managed their affairs well, most of the governments are broke. They're looking for money and how to balance income with respect to expenses. And we've got the political issues from Iran to North Korea to South America to other places. It's a real difficult environment. Governments, our own government, I would say, is essentially dysfunctional. It just doesn't work. Difficult making decisions. You know, if you look back several decades ago, you had most of the people in government, whether Republicans or Democrats, were more moderate. They were in the middle, and people would compromise, make decisions. And now we're very polarized. Very few people in the middle. They're extreme left, extreme right. Decisions are not being made. And yes, I guess it comes with age. You become more and more opinionated. But I think everyone has opinions here, but we play the blame game. We're so into trying to determine who we can blame for what happened yesterday versus looking and assessing, here are the problems and the issues that are multi-year that we have to address and start making some decisions looking forward in doing. And there's not a lot of leadership, and the world really needs leadership. In the world, and I'm quite biased, the world really needs leadership from the United States. Now, the oil and gas business environment. Well, access issues. Access issues are, if you look back decades ago, a company like ConocoPhillips, we could go just about anywhere in the world and we could explore, get acreage to explore, to find oil and gas, increase our reserves and increase our production. That's not the case today. Access is a real difficult challenge. We have the emergence and growth of the NOCs, the national oil companies. National oil companies are big, they're strong, they're very capable, and what they've done in their own country is say, well, why would it be natural for us to go to other places in the world and to do what we do well in our own host country and do it in other countries? So they are big, strong, and good competitors, normally with a cost of capital less than the IOC companies. So it's quite a challenge. How do you create value for the shareholders? The middle point in that hostile public perception of fossil fuels, it's something that's always been there, but it certainly is there today. And what's really difficult is the public, well, I've got a slide here, I'll comment here a bit more on it, I'll save my point on it, but the public perception of fossil fuels, oil, gas, and coal, is not good, but we're really dependent on fossil fuels for most of our energy for decades to come. And when we look at the business environment that we're in, we have to operate, make investment, and continue to grow, and we don't always know what the rules are, regulation-wise, for new capital projects or what's going to happen with tax law. But the shareholders always demand returns in the short term. So the bottom part of that slide says, irrespective, whatever the business and political environment is, we need to understand it. Not that we have to accept it, but we need to adapt, and we need to keep going forward because we're in a long-term business of providing, as I said, a noble business, providing energy for the world. So what's the right size? Should we be integrated? Should we not? We need to always develop our technology, more research, how we get oil and gas out in more challenging places, and always know what the shareholder wants. So, logical question, do we have a national energy plan? And the answer is no, we haven't had one for decades. And we tend to support, well, if you look over a period of time, sometimes we like clean coal, sometimes we like natural gas, and sometimes, up until recently, we even were thinking of getting back into nuclear. We obviously, big theme over the last number of years is green energy. But with Fukushima, I think nuclear has been set back for several decades. And so one of the points there is, irrespective of having no national energy plan, we continue to have to grow and develop our respective companies. President Obama, when he ran for election in 2008, and continues to be, and pushed very hard, a green energy plan. But he found very early when he became president, within 3 to 6 months, that the creation of 5 million new jobs from green energy, it was not sound. It was not a valid concept. It was not going to happen because it wasn't based on substance or research that said that people would invest this kind of money and create this number of jobs. So we have a lot of populist message that's not on the energy strategy or plan for our country. It's about tax loopholes and whatever, which is really a sideshow from really what the country needs with respect to a national energy plan. But then the bottom part of that slide is here, irrespective of situation, the industry, through technology of horizontal drilling and fracking, have opened up a whole new area of unconventional liquids and natural gas in a way that we didn't think we had 5 and 10 years ago. It was really developed by the independents. So irrespective of not having a national energy plan, the industry has come forth, and we as a nation and North America are blessed with an abundance of clean energy that's not just decades, but potentially centuries into the future. And that is really helpful politically, and it's helpful for competitively the United States and North America in the world. You see, as an industry, as I say, we invest billions of dollars, we make investments, we create a lot of jobs, and we pay a lot of taxes. Toward the bottom of the slide, we used to talk about energy security. Energy security for us, before we've had all this unconventional development of oil and gas, energy security was, let's make sure that we're developing all forms of energy from all parts of the world, And having diversified portfolio, that's the best way to have security. But toward the bottom of the slide, the very bottom, we're now talking about energy independence, something I didn't think we'd talk about 2 or 3 years ago. And it's because of what's happening in North America on conventional oil and gas. That instead of importing 60 and 70% of our energy needs, we can see in the next 10, 20 years having it down to 20 to 30%. And when you're down to 20 to 30%, and a lot of it's coming from Canada, you are in a good position and you're pretty independent. So the bottom part of this slide is the industry is doing so well that the government needs to not screw it up. I can't say it any other way. So we just need good regulation, and obviously we've got to make sure we do things right, but we don't need overabundance of regulation. Let the industry do what it does well, and what you do so well is build and develop projects, and we will see to it that we have the energy that we need that's clean and that it's affordable. Now, I've also been asked about, well, why did ConocoPhillips split upstream and downstream? We built this company, now we're tearing it apart. Well, not tearing it apart, we're in the same business as upstream and downstream, but they're going to grow and thrive as two companies versus one company. Now, within the company, the question was, well, when did we just think about that? We've thought about that over the last 3 decades. We'd always asked for an upstream and a downstream company like ConocoPhillips. The physical integration was a natural gas liquid stream that comes from the upstream that goes into making petrochemicals and goes in the refining side of the business. And they're two different businesses. But historically, for 100 years, integration was so important because years ago, if you found oil in a very exotic place in the world, and oil prices were very low, the question is, well, does the oil have value? But if you had refineries and a downstream, you'd say it has value because we'll run it in our refineries. Today, you don't. The oil that you produce, seldom is it run in your own refineries. And if you find oil and liquids, it has value of $90 to $100 a barrel. You don't have to have a downstream at a market to sell your oil. And the other thing that was always important is over decades is sometimes you made the money in the upstream part of the business, sometimes in the downstream. And they would balance off each other. And if they balanced off on each other, the stock market said that's a more predictable, less volatile earning stream, and we'll pay a higher PE multiple for that stream of income. That's no longer the case. They value each business differently. So the third subpoint there is two different businesses. Now, I look at our own company, ConocoPhillips, for the last 10 or 15 years, and we tended to take more of the cash and put it to exploration and production or returns and distributions to the shareholders, and then put as much money to the downstream part of the business, which is refining, marketing, transportation, and the petrochemical side, and the midstream part of the business. So you see in there, I say, IOC's abdicated downstream. In other words, what happened is we put more of our money toward E&P and more towards distribution to our shareholders, and what abdication means is you saw new players created to create very large companies with a lot of value, like Kinder Morgan, Enterprise, ONEOK, and others. And we're saying that's space that we historically have been in. So our view is, within ConocoPhillips, two separate companies, very pure play, and they're positioned with very strong balance sheets to grow and thrive in the upstream part of the business, downstream part of the business, create value for the shareholders. And they're well capitalized. And the stock market says, this is the view, when you're an integrated company, I'm not saying that this is a decision that everyone should, but it made sense for ConocoPhillips. Stock market says, when you're an integrated company, you're making the decision for us to put money in E&P or the downstream. When you're pure play companies, then I make the decision whether I want to put all my money in E&P or I want to be in downstream. So they like pure plays, and historically it does show with growth and development, you create more value as separate pure play companies than you do as integrated companies. Our execution of splitting the company into upstream and downstream was absolutely impeccable, and that was understood in the financial community as well as in the industry. We did it, I think, in about 9 months of saying that we were going to do it, and it was done without any compromising of operations, cost, or certainly our HSE performances. Each year was better than historically we set a new record. Now, I've also been asked to talk here for a moment about mentoring and leadership and just reflecting in personal experience. When it comes to high potential employees, you need to identify them, and they need to know that they are a high potential employee. And they need to be able to grow and develop, make mistakes, but nothing that's, making mistakes and making decisions that grow and develop, but not mistakes that have a real adverse impact on the company. Support development of skills, give them exposure to management, to board of directors, and do it in a way that you're not pitting one high pot against another high pot or creating winners and losers in an organization. That's not a good situation. And develop authenticity and uniqueness. In fact, I was asked, some of the examples you might have with respect to who you think are really great leaders. And of course, you start thinking in business and whatever, in sports. Well, I thought about this over the last couple of weeks and said, here, leadership examples. I'm not going to spend a lot of time on this because I think I've pretty well used most of my time here today, but I just put those names up there to get myself thinking, but to get you thinking as well. Is who are leaders? They're leaders in all types and forms of life. It could be in politics, sports, religion, wherever, business. But the important thing is the bottom part of that slide. These great leaders are unique. They're authentic. They're visionary. They have strategy. They know where they want to go. They're committed. And they have a relentless pursuit. And they communicate well. And they have teams. And they understand who they are, what they stand for, and they understand their organization, who they are, what they stand for, and what they want to accomplish. So these really, just to get you thinking, but these are people that I look at for their point in time and what they were faced with are certainly true leaders. So to conclude, hopefully covered a lot of ground here about ConocoPhillips' lessons learned that may be of interest to yourself, the challenges of organic growth versus M&A type transactions, the importance of people, mentoring, leadership, corporate governance, culture, a little bit about the current business, political environment, and conclude as I started, CII is a very important institute to the success of everyone that's here and participating, but certainly to the members and to ConocoPhillips. We really want to say thank you to what CII does and what you do for us and what you do for your members. Thank you very much.